Hi guys, today's video will be about the accounting equation as well as using debits and credits. So the objectives today are to explain the accounting equation and to explain the concepts of double entry accounting with regards to the accounting equation, debits and also credits. So let's look at the accounting equation. So it's A, assets equal to liabilities plus shareholders' equity. Our assets are our resources and our liabilities and shareholders' equity are our sources. Okay, so what's the story behind these names? Okay, so assets, if we remember the definition, are resources controlled by an entity as a result. So controlled by an entity as a result of a past event from which future economic benefit will flow. Okay, so in order to acquire these assets or items, we need funding. So we need funding or money to acquire them or buy them. So there are only two types of money that we can fund our resources from. We can either borrow the money and pay it back later, or we have money that we already have ourselves that we originally have. Okay, so the externally sourced money that we get or money that we need to borrow and pay back are liabilities. So these are present obligations of the entity arising from past events, the settlement of which is expected to result in the sacrifice of economic benefit. Now the internally sourced money or the internally sourced funds that we use to acquire or buy assets, this is money that we have on our own and that's our own. It's what we call shareholders' equity and that's the residual interest of assets that are funded by equity. So again, if we look at our assets, if we have these assets, our sources are pretty much the sources of funding that we get them from. So we can either get our sources of funding from liabilities, so from bank loans and things like that, or shareholders' equity, which is our own money. Okay, so I'll give an example. So if you had a house for $500 and the money you needed to borrow to get that house was $450,000 and you have your own money of $50,000, what is your assets, liabilities and shareholders' equity? Okay, so your asset is the house, which is worth $500,000. That's the historical cost of it. Your liabilities is how much you've borrowed externally, so that's your $450,000. And then lastly, your shareholders' equity is $50,000 that you have your own, okay? It can also sometimes be called owner's equity or shareholders' equity. So now we move on to double entry accounting. So what is double entry accounting? It's a system of accounting that requires every entry, so every entry of the journal entries that increase the balance of one account to have an equal but opposite effect on another account. In other words, to decrease the balance from the other account. So if we think of it as a destination account, and an origin account. Okay, so an increase of funds in our destination account must have come from somewhere. So we're saying it must have come from our origin account. So if we want to increase the amount that we have in destination account, that means that we necessarily have to take that same amount from our origin account. And as a result, an increase here will cause a decrease here. So when we apply this to our transactions that affect assets and liabilities and shareholders' equity, we have to use we're going to be using a chart. So we use the accounting system of debits and credits for each transaction to help us. So a debit is the opposite of a credit. So how do we know when do we use debits and credits? So if we just look at our accounting equation, assets equal to liabilities plus shareholders' equity, and our golden rule, debits equal to credits, we have in accounting, tradition states that assets over here have a debit balance, and so our resources have a debit balance, and our sources all have a credit balance. Okay, so we're going to start with the balances here. So assets have a debit balance, DR for short. Our liabilities and shareholders' equity, that has a credit balance because these are resources. Because our revenues increase our profit, which increase our shareholders' equity, this is considered a credit balance. And because our expenses decrease profit, which decrease shareholders' equity, we consider them having a debit balance, okay? So normally, an increase in assets, if it has a debit balance, in order to have a bigger debit balance, we must obviously increase it with a debit, okay? So therefore, if we have a normal debit balance of an asset, in order to decrease that asset, we need to reduce the amount. As a result, we need to credit the account, which is the opposite of increasing it. So if we debit one account to increase it, we therefore have to credit with the opposite sign to decrease it. So if then we go to liabilities, if it normally has a credit account, in order to increase that credit account or that credit balance, we obviously need to provide another credit. So another credit to increase the credit. Whereas if we want to decrease the credit balance, we obviously use a different sign. Obviously we use the debit to decrease the normal balance. Okay, then if we move to shareholders' equity, just here, if there is an increase, if there is an increase in shareholders' equity, we have to have a credit balance in order to increase that credit. However, to decrease the credit balance of our shareholders' equity, we need to use the opposite sign, so a debit balance. And then also, obviously, if there is an increase in revenue, that will be a credit balance. And if there is an increase in expenses, there will be a debit balance. So there aren't actually ways that we don't usually have values for decreasing revenue and decreasing expenses. But if we do, for the sake of it, we can all we need to do is just flip the signs. So just to reiterate, in order to increase an asset with a debit balance, we obviously need to provide another debit. So that's why we have a debit here. And in order to decrease that debit balance, we need to use a credit, which is the opposite sign. Okay, so that'll apply for everything here. So obviously for liabilities, it's got a credit balance. To increase that credit balance, we add another credit. To decrease that credit balance, we subtract it with a debit. That's the same with shareholders' equity. If it has a credit balance, because it's a source, in order to increase that credit balance, we add another credit, and then also to decrease that credit balance, we have to subtract it with a debit. Okay. Okay. Yep. So that's the end of the lesson today, guys. I've hoped you learned something. Thank you.
Cut study time with concise video summaries by top students. Visit spoonfeedme.com to view more free videos in this course and hundreds of others.